Hello, Sage Seed. Now, actually, one of my friends was talking to me about companies that he's seen other people buying, companies that are maybe a little bit more under the radar that he's seen other people buying. And he does live in Dallas. Here, there is a Dallas company. I'm excited to look into it for the first time. Let's dive in so that our wisdom can blossom. Going straight to our opening move, we're at the income statement. Revenue growing very, very quickly. And whatever this business does, it ramped up expenses in between 2020 and 2021, and then is actually decreased how much more expenses it has needed to create in order to get the latest round of revenue. The earnings per share have gone from $2.69 just 2 years ago to almost $17. Clearly, something correct is happening in the latest years. The consolidated balance sheet. While this has been happening, the company's current assets have actually decreased, as have total assets overall. It's not always the case that a company making a lot of money has to grow. In this case, the company's actually shrunk. Statement of cash flows. There it is again, beautiful net income growth. And interesting to note, depreciation escalating very, very rapidly. On the working capital side, lots of pretty big numbers across the board, but some negative years, some positive years. All of this actually looks just pretty standard stuff. And so, in conclusion, for the opening move, 100%, we got to look at that depreciation. How did it just almost quintuple, I think it was, in a single year? And then what went wrong that they had to then bring it back down? If we can discover that, I think it'll help us understand why this company doesn't think it's a growth company because it isn't acting like one, even though its earnings per share have grown ridiculously. Continuing right away to the notes to the financial statements, this company is helping the construction process. CFO department then helpfully breaking that down into some categories for us. About a third of everything, actually more than a third of everything, is in lumber and lumber sheets. And so actually mainly just supplying the actual wood for a lot of building constructions. As we've continued down these notes, there's actually two big differences between what type of depreciation that in the cash flow statement were just grouped up into one. One type of depreciation is the usual type of depreciation. Here we have a section for their different measures of everything they own, their land, their machinery, blah, blah, blah. Here we can see the accumulated depreciation. It's about 160 million in depreciation that is related to this more usual type of depreciation. Now, the number on the cash flow statement was a lot higher. I think it was over 500 million. And so there's at least 300 million difference. That is a different type of depreciation. And while I haven't found the exact number yet, I'm suspecting it has to do with what the CFO department has spent most of the time talking about as I've been scrolling through acquisitions. We eventually find this paragraph explaining the largest of these acquisitions. They call it the BMC merger. You can see I found them explain that they're receiving depreciation expenses related to absorbing these assets at what they're calling fair value. Visually on the statement, what I'm talking about is the difference between depreciation in this year and depreciation a year later. A little bit of change in the business, but mostly, significantly mostly, the acquisition of this other company called BMC. We just bought this for X, but immediately we think the actual equipment that we're buying is worth less than X. Maybe we're not going to use it. Maybe what we really care about when we bought this company was the customers, not necessarily the machines they were using. It's not unlike how HR in our block was doing things a couple of weeks ago that we saw together. I think the word I used there, a little aggressive, it's kind of putting down competitors. RIP. But what's fun about this? Well, hundreds of millions of dollars of write-downs lower your taxable income. It would not be crazy to interpret that increased depreciation, even if it's just temporary increased depreciation, would free up hundreds of millions of dollars of what would have been taxable income. Another part of this report very much describes an increasing stock repurchase program, a share buyback. Woo! Besides loving these for all sorts of reasons. You should also begin to ask yourself, where does the money come from the share buybacks? While the share buyback expansion is larger than what would be just explained by this depreciation, it's a slightly larger number than you would expect just based off of the income statement alone. The difference is not coming from working capital management from what I'm seeing here. One of the only places where the extra hundreds of millions of dollars in share buybacks could be coming from is actually this depreciation number. And so, why would a company buy another company just to say that its equipment is basically useless and write that off as a cost? Well, if that company is knowing that they're going to immediately use that saved taxes in order to buy back shares, no harm, no foul. It does not increase assets, which would then lower the management's own return on assets. It actually boosts return on equity. Hey, if you're getting more comfortable uncovering the stories behind the numbers, please like and subscribe. It's not exactly rocket science once you're in the corporate finance world, but something that a lot of us could easily miss if we didn't really try to look closely at connecting the dots between different paragraphs that management is saying. Management at no point tells us, hey, yeah, part of that acquisition was us boosting return on equity artificially. That's why last year looked so successful relative to first years. I mean, if they just told you that, you wouldn't be nearly as impressed as an investor. The board of directors, a lot of times, is looking at the metrics like return on equity, seeing stable return on assets. Basically, this management's looking really good. As an investor, we should take away that this is real. It's some high level corporate finance, but it's not cheating. It's all legitimate and fair, but it isn't long-term growth. That's the only thing that as an investor we might want to remember. Income is temporarily decreased by this depreciation. And so while the company has grown market share, perhaps permanently, hopefully permanently, it has juiced its ultimate return on equity temporarily. Eventually, that return on equity will have to come down again. What does that mean? At first, net income would get the boost. They did it in 2021, which boosted 2022. If they're doing it again in 2022, which it looks like they are, it's going to boost 2023, which we'll check out in a couple weeks. But it's a one-time party trick, meaning that after the boost, net income will actually decrease by a somewhat balanced amount a year later. And so in this case, we can expect income in 2024 to fall down again. This is kind of like giving net income steroids. Just roid it out. And then it comes back down a little bit worse for the whole experience, but should have been showing the earnings per share here. This level of 17 is boosted, is roided up. They're going to be able to keep roiding up for a couple of years, but no company can do it permanently. I don't know. Does it fall back down to 9? Does it fall back down to 3? I certainly don't think it falls back down to 3 because there have been multiple acquisitions, real acquisitions, between now and back here. So I don't know where the long-term earnings per share is going to be for this company, but certainly higher than a few years ago. In the worst case, if this company attracts a couple of investors to the stock that wouldn't have noticed it without the boosted return on equities, that's only good for the existing shareholders. The real losers of this are potentially the company that was acquired. If you think it through, you might realize that that's where a lot of the value extraction is coming from. It's not a friendly takeover of a business by any means. Usually these are less than friendly acquisitions. With that said, we're now asking Sage Seeds AI to tell us what the valuation ranking is right at the end of the 2022 season. This might be the actual last video of the 2022 season. My guess is that this is going to score quite high. I would say top 20%. Honestly, this is good. It's a great company, real growth, and it's boosting. So I think it's going to get a high ranking. What do you think, though? Please remember to like and subscribe, to share with your friends, show them the video, ask them what they think Sage Seeds AI is about to say, because then if they're wrong, you can laugh. Sage Seeds AI is trained to identify potential value investment opportunities. BLDR is ranked 223 out of 620 in value for the 2022 season. This is not changing much because the season is practically over, and it's a good ranking. A little bit less than what I was thinking, yes, but we can gloss over that because it's still green. It's still green. The company in the year of this annual report was expanding the share buyback program, meaning that the roiding will continue. In a couple weeks, we will see an updated ranking for the 2023 season, which is a much younger season, yes. But I expect this one to be very much in the top percentiles in that season as well. Thank you to my friend for mentioning this company, saying that he thought a video would be cool. If you have any companies you'd like me to look at, please let me know in the comments.